Most people believe their retirement plan is safe because it follows the rules that have worked for decades: contribute consistently, diversify between stocks and bonds, trust the system, and allow time to do the heavy lifting. But what if the system those rules were built on is now beginning to fracture? What if the structure behind the modern retirement strategy was designed for an economic world that no longer exists? Because in 2026, something subtle but extremely important has begun to change beneath the surface of the global financial system. And the impact of that change could reshape how retirement wealth is built, protected, and ultimately preserved. What Wall Street isn't telling you is that the assumptions behind the traditional IRA strategy were built during an era of falling interest rates, expanding globalization, and relatively stable monetary policy. That era may now be ending. Over the past 4 decades, investors have been conditioned to believe that long-term retirement planning is simply a matter of discipline. The formula appeared simple: contribute to tax-advantaged retirement accounts, rely on compound growth, and allow markets to trend upward over time. But this strategy depended heavily on a financial backdrop that provided strong tailwinds. Interest rates moved downward for nearly 40 years, boosting both equity valuations and bond prices simultaneously. Inflation remained largely contained, allowing central banks to support markets during times of stress, and global supply chains helped keep production costs stable, which supported corporate profits and economic expansion. But the environment unfolding in 2026 looks very different. We are now witnessing a global economy defined by persistent inflation pressure, geopolitical fragmentation, rising sovereign debt levels, and an increasing shift toward protectionist trade policies. Government deficits continue expanding as demographic changes place enormous pressure on social spending programs. Debt servicing costs are climbing as interest rates remain elevated compared to the ultra-low rate environment investors grew accustomed to. These pressures are not isolated to one country. They are global in scale. And this is where things get serious, because retirement planning models assume relative economic stability, predictable growth, and a reliable relationship between risk and return. But when the underlying structure of the global economy shifts, those assumptions begin to weaken. History shows us that financial systems evolve in cycles. Periods of stability often give way to periods of structural change. In the 1970s, inflation eroded purchasing power at a pace few investors had experienced before. In the early 2000s, the bursting of the technology bubble reminded markets that growth expectations can become disconnected from reality. In 2008, the global financial crisis exposed vulnerabilities in banking systems that many believed were highly regulated and secure. And each time, investors who relied solely on conventional wisdom were often caught off guard. And this is where history repeats itself. Structural transitions rarely announce themselves clearly. They unfold gradually, often disguised as temporary volatility or short-term disruption. One of the most significant hidden risks facing retirement portfolios today is the assumption that diversification alone can protect against systemic change. Traditional IRA allocations often rely heavily on equities and bonds. But when inflation remains persistent, bonds can struggle to deliver real returns. At the same time, equity valuations can come under pressure as higher interest rates reduce the present value of future earnings. This creates a challenging environment where the 2 primary pillars of retirement portfolios may no longer provide the balance they once did. What Wall Street isn't telling you is that the relationship between stocks and bonds is not fixed. It is influenced by macroeconomic conditions, monetary policy, and investor psychology. Meanwhile, global central banks are navigating a delicate balancing act. They must attempt to control inflation without triggering economic contraction. They must maintain confidence in financial institutions while managing unprecedented levels of public debt. And they must do so while geopolitical tensions reshape global trade relationships. The transition toward a more fragmented economic world introduces uncertainty into currency markets, commodity pricing, and capital flows. These factors ultimately influence retirement portfolios, even if the connection is not immediately obvious. Consider the role of government debt in shaping future investment conditions. As debt levels rise, governments face increasing pressure to maintain economic growth in order to service those obligations. This can lead to policies that favor financial stability over market efficiency. It can also create incentives for prolonged periods of monetary accommodation or financial repression, where real returns on traditional savings vehicles struggle to keep pace with inflation. For retirement investors, this creates a silent challenge. Even if portfolio balances appear to grow, the purchasing power of those assets may not increase at the same rate. Another factor quietly reshaping retirement strategy is demographic change. Aging populations in developed economies are increasing the demand for retirement income while simultaneously reducing the size of the workforce supporting economic expansion. This dynamic places strain on public pension systems and increases reliance on private retirement accounts such as IRAs. But if market conditions become more volatile, sequence of returns risk becomes more pronounced. This means that the timing of market fluctuations can significantly impact long-term retirement outcomes, particularly for those approaching retirement age. But here's where the situation becomes more complex. Financial innovation continues to introduce new investment vehicles, alternative assets, and evolving strategies designed to address modern market conditions. Some investors are exploring broader diversification beyond traditional equities and bonds. Others are reevaluating risk tolerance in light of changing economic dynamics. The key challenge is not predicting a single outcome, but recognizing that the range of possible outcomes has widened. And when uncertainty increases, strategic flexibility becomes more valuable than rigid adherence to outdated frameworks. The 2026 IRA strategy is not about abandoning long-term investing principles. It is about recognizing that the environment those principles operate within has evolved. It involves understanding how inflation impacts real returns, how interest rate regimes influence asset valuations, and how global geopolitical shifts can alter capital flows. Investors who acknowledge these realities are better positioned to adapt their strategies over time. Those who ignore them may find themselves relying on assumptions that no longer hold. Throughout financial history, moments of transition often create both risk and opportunity. During periods of uncertainty, markets can experience heightened volatility, but volatility can also lead to price discovery and structural rebalancing. Investors who remain informed and adaptable can navigate these transitions more effectively than those who rely solely on static models. This is why understanding macroeconomic context has become increasingly important for long-term retirement planning. Past and Profit has consistently emphasized the importance of examining financial trends through a broader historical lens. When viewed from this perspective, the current environment appears less like an isolated disruption and more like part of a longer cycle of economic transformation. Structural changes in global trade, energy markets, fiscal policy, and technological development are converging simultaneously. Each of these forces has the potential to influence long-term investment performance. But perhaps the most important takeaway is this. Retirement planning has never been purely mathematical. It has always been influenced by policy decisions, economic cycles, and investor behavior. As we move deeper into 2026, the interaction between these forces appears increasingly complex. Traditional assumptions about diversification, risk, and long-term growth may need to be reevaluated in light of evolving macroeconomic realities. And this is where the future becomes uncertain. If inflation remains persistent, if debt levels continue rising, and if geopolitical tensions reshape global markets, the structure supporting conventional retirement strategies may look very different in the years ahead. Investors who understand these dynamics may be better prepared to adjust their approach. Those who ignore them risk relying on frameworks built for a different era. What Wall Street isn't telling you is that retirement success has always depended not just on time in the market, but on understanding the environment shaping that market. And as history has shown repeatedly, environments can change faster than expectations. The 2026 IRA strategy is ultimately about awareness. Awareness of macroeconomic forces, awareness of structural transitions, and awareness that financial systems evolve over time. Because when systems change, strategies must adapt. And when strategies adapt, outcomes can improve. But ignoring change has rarely been a successful long-term approach. The coming years may test conventional retirement assumptions in ways many investors have not previously experienced. The question is not whether markets will continue evolving. They always do. The question is whether retirement strategies will evolve alongside them. The global financial system has entered a period where confidence, policy, and economic structure intersect in complex ways. Each shift influences the others. Each policy decision introduces new variables, and each variable shapes the long-term outlook for investors seeking stability in an uncertain world. The warning signs are not necessarily signals of immediate crisis, but they are indicators of transformation. And transformation often rewards preparation. As the economic landscape continues to evolve, the ability to recognize changing patterns may become one of the most valuable investment skills, because history suggests that the greatest financial risks are often not the ones investors see clearly, but the ones hidden beneath familiar assumptions. And for millions relying on traditional retirement strategies, 2026 may represent a turning point where understanding the bigger picture becomes just as important as selecting the right portfolio allocation. The future of retirement planning is unlikely to be defined by a single event. It will likely be shaped by a series of interconnected developments unfolding over time. Each development may appear manageable individually, but together they can redefine expectations. And this is where things become truly significant, because when expectations change, markets respond. When markets respond, strategies must evolve. The investors who remain attentive to these structural changes may find themselves better positioned to protect long-term purchasing power. Those who remain anchored to outdated assumptions may face increasing uncertainty. The goal is not fear, but awareness. Not reaction, but preparation. Because the biggest financial shifts rarely appear obvious in the moment. They become clear only in hindsight, and by then, the opportunity to prepare has often already passed.